let's get an expert opinion on what we've heard so far and what the markets are watching out for. We're joined by Loeys, Chief Investment Strategist at JPMorgan. Jan, thank you very much for joining us. We've got some bit from Sarkozy in terms of that 200 billion euros that the ECB will lend to EMF to support bonds. We also hear that the ESM mechanism will be advanced to mid-2012, which means there's little more money available for buying bonds. Not little more, a lot more, 500 billion euros getting advanced. Is that good enough to support markets now?
I think it is more than what a lot of investors expected. Every summer we've had in the last 2 years really has disappointed. So Europe moved forward. The lending by the IMF is clearly good news. The fact that the ESM is brought forward. Also, I understand, assuming it will be in a final communique, is that the European or the EU members will agree to look again at the size of the ESM as conditions developed. So the 500 limit at the moment could actually be increased. I think a lot of investors have been positioned very defensively going into this communique. There was a bit of an uptick this week in this, but there's still a lot of cash sitting on the sidelines, and I expect in the next few weeks to see a decent up move in equities.
And we've heard quite a lot today from almost all of the leaders. Important takeaways. What are you expecting now on day 2? Is there anything significant that you will be watching out for?
Well, day 2 will be Saturday, but if you mean what will happen in the next stage, we have an idea what the communique is going to be. There will be now work in coming months towards getting what has been baptized by ECB President Draghi, the fiscal compact, which will involve a lot of the EU countries, but not all of them. UK seems to be out of this. An agreement between the Euro members to move towards significant fiscal limits. Really a replication of what they had in the Stability Pact at the beginning of monetary union, 3% deficits and 60% debt to GDP. But now they're working to make that actually enforceable. There are no details yet on how they're going to do that. I suspect it is going to be an intergovernmental agreement that does not have to have a treaty revision, doesn't have to go through every parliament or referendum, but it will have some form of automaticity and automatic penalties.
Okay, actually the European indices are now in the green, so a clear U-turn from where they were in the first 5 minutes of trade. But Jan, one of the points to watch out for really is how much money is available for supporting bonds. Now, a lot of market watchers, we understand, are looking at what the ECB makes of what the summit has agreed to. It's not enough if the market thinks that this is a good deal, but the ECB has to think that it's a good deal, and the ECB action thereafter will determine how much bonds get supported. What are you expecting to hear from the ECB, and what might satisfy the markets, you think?
I think the way we need to look at this is the ECB as a backstop. You should not expect, irrespective of really happening at the summit, for the ECB to become the committed lender of last resort. Whatever the letter of the communique says, the ECB wants to see action. The only way that it can get action from countries on economic reform, on fiscal reform, is to keep a bit of threat of buying or not buying by the ECB in the background, not committed, conditional. So think about the ECB wants to make sure, obviously, the euro does not blow up. At the same time, it wants to make sure that all these promises of these countries to clean up, to reduce their deficits, to start to deregulate their economies, to get their economies going, ECB wants to see that in action. So it will be a buyer. It will make sure it doesn't blow up. At the same time, it'll be a bit in the background in this. It knows that, the ECB knows that if it fully comes out and saying we make sure that none of these bond markets will have a yield of more, say, 4 or 5%, at that moment, all the words of the summit being written down today and signed up will remain words. It needs to see that implemented in action. So volatility will not go away when some countries backtrack and don't really make progress. You will see these bond yields move up and the ECB not being a buyer anymore.
And what's your sense on equities then? In the run-up to the event, we've already had a significant 8-9% rally in the developed markets at least. Do you think there is more room for upside here? And also your view on emerging markets in India in particular?
There are very significant upside on equities. The real driver of equities is not so much valuation. The real driver is that investors have been moving into cash, into defensive positions due to uncertainty about the world. And the number one is the risk of a blow-up in Europe. So there remain massively underweight equity positions in the world that will be gradually put to work. I think the market will recognize that today is not the final word in Europe. We need to move from words into action. So I think I expect to see a steady commitment of investors, reductions of their underweights. The biggest underweight is in Europe, so I think in the next 1 or 2 weeks into year-end, you'll see Europe outperforming. There remains very significant interest of investing in the U.S. There's a reluctance to move into emerging markets, largely due to the slowdown we're seeing across Asia in industry and concerns about the impact of all across Asia, including India, of the housing collection in China, questions on whether they will turn into a crash. So my preference really in the next 1 or 2 months is to be in Europe and the US rather than emerging markets.
Do you suspect, as some people have said, that India would be a relative underperformer in 2012, at least the first half of 2012, that it might trade at valuations lower than its historical averages?
I think India is not going to see major inflows by international investors. So there is an inflation issue. Growth is coming down. The questions about fiscal policy and regulatory policy by the government. And India is in a dangerous neighborhood. It is a huge economy, but the global investors keep looking at China as a leader, and they are worried about the Chinese housing market. So I don't see a lot of inflows into this region. At this moment, at best we would do is to have India neutral. I would think even on an underweight at this moment.
All right, Jan Loeys, we'll leave it at that. Thank you very much for joining us with your thoughts.